Welcome back to Investing Talk Podcast.
Today we're looking at Oracle.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For decades, when you thought of this company, you thought of, well, databases, right? ERP software.
Right. They were the entrenched leader, the essential enterprise plumbing, a predictable and, frankly, a relatively mature cash flow machine.
Exactly. But that narrative it's just completely obsolete now. This isn't a database company anymore. This is a pure AI infrastructure play.
And the data is just screaming transformation. So what are the headline numbers that are proving this shift is really happening?
It's a phenomenal pivot. And the data absolutely backs that up. If you look at the Q2 fiscal year 2026 results, total revenue hit about $16.1 billion.
Which is a solid number, what, 14% up year over year?
That's right. But you really have to look deeper. You have to look at the engine that's actually driving that growth.
Let's talk about that engine. That mix shift is everything.
Precisely. Cloud revenue, and that's both infrastructure and software as a service, IaaS and SaaS. That was the real driver. It surged 34% year over year to $8 billion.
So cloud services are now, what, almost 80% of their total revenue?
Around 77%, yeah.
Yeah.
And that is the most important metric because it shows the legacy business is, well, it's being eclipsed by this huge cloud transition.
And within that cloud number, we have to isolate the infrastructure side, OCI. That's the part that ties directly to this high-growth AI story. Is that accelerating?
It's accelerating dramatically. Cloud infrastructure, OCI, consumption revenue, it grew 68% in Q2. Management is even guiding for that to surpass 70% for the full fiscal year.
70%. We are talking about massive, explosive growth figures in a segment where they're still competing with giants like AWS and Azure.
This isn't just some incremental improvement. This is a fundamental multi-year acceleration driven purely by the demand for AI workloads.
So 70% growth is today's story. But what really struck me is that they aren't just selling the capacity they have now.
They've sold capacity they haven't even built yet.
Exactly. Which brings us to future visibility. And frankly, I had to double-check the figures on the remaining performance obligations, the RPO. That $523 billion figure is just, how do we even interpret that?
It is an astronomical number, and it absolutely demands some context. RPO is, essentially their backlog of contracted future revenue.
And it hit $523 billion in Q2.
To give you some scale, that number is 5 times the last 12 months of reported revenue. It's a staggering 438% increase year over year.
A nearly 5-fold leap in contracted revenue in a single year. And this isn't just a bunch of small, typical software contracts.
Oh, no, absolutely not. This backlog is built on multi-billion-dollar AI cloud deals with key customers. We're talking major players like Meta and NVIDIA.
So when the biggest names in AI are locking in these multi-year deals, it's a massive validation of the technology.
It's a huge confidence signal. But let's narrow that down. For the listener who wants to know what happens now, when does that cash actually hit the top line?
That's the crucial part, the near-term visibility.
So roughly 33% of that $523 billion is expected to be recognized as revenue within the next 12 months.
So over $170 billion in revenue is basically guaranteed over the immediate horizon. That provides incredible insulation against, broader economic worries.
It makes their near-term targets highly predictable. They've secured the business. They know the customers are coming.
So the question now becomes execution. Can they build out the capacity to handle that scale? If they do, what does management expect for the longer-term run rate for OCI? The targets seem ambitious.
They reflect that ambition. Analyst forecasts, based on current guidance and the sheer velocity of these deals, suggest OCI revenue could scale to something like $144 billion by fiscal year 2030.
Wow. If they even get close to that, it positions them for what, like 28% annual revenue growth over the next 5 years?
For a company that's been around for decades, that would be a monumental feat of corporate reinvention.
Okay, let's unpack the core tension here, because that kind of explosive growth is never free. This shift means they're spending money like a high-growth startup to capture this demand.
And that is the single largest risk factor you have to wrestle with. Management has made a strategic, high-stakes decision to front-load capital expenditures to capture this AI window.
What are they projecting for CapEx?
Approximately $50 billion for fiscal year 2026 alone.
Wait, 50 billion capex in a single year. That is a gigantic bet. That's cash they are burning now to build the infrastructure they hope to monetize later.
Exactly. And that has immediate consequences for the balance sheet. To fund this, they're projected to take on new debt. We're
Yeah.
talking nearing $200 billion on top of what they already have.
And here's the part that makes investors nervous.
This is it. This intense investment phase is forecasted to push free cash flow, FCF, into negative territory for perhaps 3 years.
Negative free cash flow for 3 years with a growing debt mountain. That's the bear case right there. Shouldn't we be extremely concerned they're overextending themselves?
It's a completely fair concern. It does feel like they're throwing a massive infrastructure party on a credit card, hoping their future profitable self will pay it off.
But you have to remember why the cash flow is negative.
Right. It's critical to remember the FCF pressure is a temporary consequence of the CapEx surge. It's not a sign that the core business is failing.
So let's talk about that core business. The legacy software side is still a cash flow engine, right? It's still immensely profitable.
Absolutely. Think of that as the highly profitable oil well that's still funding this risky gold rush. The business still generated over $22 billion in operating cash flow over the last 12 months.
And profitability is actually getting stronger.
It is, because those new AI contracts are high value. Net profit margins expanded significantly from about 21% to over 25% year over year. The operating leverage is already improving the bottom line.
And despite this huge capital outlay, they're still committed to shareholder returns.
Which has to be a sign of management's confidence. They're maintaining their 50-cent quarterly dividend, and they just announced a $10 billion share buyback.
So they're walking a tightrope, using cash from the established business to fund both the AI build-out and shareholder returns at the same time.
It shows real conviction that the future profits are robust enough to handle the immediate financial stress.
Okay, here's where it gets really interesting, moving beyond the financials.
Yeah.
Why are players like Meta and NVIDIA choosing Oracle over AWS or Azure? Where is the competitive moat that justifies that huge backlog?
Well, their moat is complex. It's built on two classic advantages and one major modern twist.
What are the classics?
High switching costs. It's incredibly costly and risky for enterprises to re-platform their mission-critical database systems and their fusion applications. ERP, HR, all that.
Okay, so that's the stickiness. What's the modern twist?
The modern twist, the key differentiator in this AI race, is their aggressive multi-cloud strategy and their specialization in performance.
Explain that multi-cloud strategy. I mean, if they're embedding their data centers inside AWS and Azure, doesn't that make them perpetually reliant on their competitors?
It sounds counterintuitive, but it's a really profound strategic move. They're more than halfway through building 72 of these multi-cloud data centers embedded inside competitor clouds.
So the goal is to eliminate latency.
Exactly. Customers can run their Oracle database workloads right next to their other cloud services without any costly, complex migration.
That's brilliant. They're turning their biggest competitors into distribution partners for their core, high-margin product.
And it is highly effective. Their multi-cloud database business, which includes things like Oracle Database at Google Cloud, is their fastest-growing segment. It was up an astonishing 817% year over year in Q2.
Wow.
It's a massive competitive shield. Plus, they practice what they call chip neutrality, buying the best chips, whether it's from NVIDIA, AMD, or Intel. This gives them an agility advantage.
So the multi-cloud approach locks in the infrastructure, but the real lock-in happens at the application layer, right? What are they doing with their Fusion software to make sure customers stick around?
They are embedding AI across all three layers: infrastructure, database, and applications.
Yeah.
Within Fusion, they already offer over 50 AI agents, and they're targeting over 600.
And the key is how they price them.
Crucially, they offer these agents at no extra license fee. This instantly locks in enterprise customers with end-to-end AI-augmented workflows, making it incredibly hard to switch.
And we also have to note the sheer physical scale they're pursuing.
That's right. Over 211 live and planned cloud regions worldwide. Management says that's more than any major competitor, giving them a big advantage in proximity and data sovereignty.
Okay, let's pivot to the market's reaction. The stock surged in 2025, but then we saw a significant pullback. Why the volatility?
The stock had a huge run, up roughly 87% through 2025. It priced in a tremendous amount of AI success. But it recently pulled back pretty hard, 37 to 43% from its highs.
And that was triggered by a couple of things.
Two main things. First, a broader sector-wide de-risking in AI stocks. But second, and more specific to this company, was that investor anxiety over the scale of the CapEx, that $50 billion bet, and the negative free cash flow.
So the market got nervous about the size of the risk despite the massive backlog. Now that it's pulled back, what does the technical picture suggest?
Well, analysts are generally interpreting this dip as a bullish accumulation setup, not a fundamental break. The stock is still trading in a long-term uptrend.
And there's a potential technical signal forming.
Yes, analysts note it's potentially forming a golden cross, the 50-day moving average crossing above the 200-day, which is traditionally a constructive signal. Consensus price targets suggest significant upside from here.
So institutional investors are seeing this as a buying opportunity. Why?
Because of the visibility. That $523 billion RPO with names like Meta and NVIDIA is the ultimate confidence signal. They see this as a relative value play in the AI infrastructure space.
Okay, so what should we be watching for over the next, say, 3 to 6 months? What are the milestones that will confirm the bull case?
The first major one will be the Q3 fiscal 2026 earnings, expected around March. Investors will be laser-focused on whether management can maintain or even raise their aggressive guidance.
Specifically on cloud growth.
Yes, they need to see continued total cloud growth over 40%, and most importantly, OCI acceleration hitting or exceeding that 70% target.
And beyond earnings, what about the physical rollout?
We'll be watching for tangible updates on that. Progress on the 72 multi-cloud data centers, the status of the 20 new sovereign AI cloud regions, and on the speculative side, any chatter about large government contracts could be an immediate driver.
So this really distills the core dilemma here. Oracle is making this strategic, high-stakes bet borrowing heavily, spending aggressively to capture AI market share.
But that risk is absolutely necessary to realize the potential of their massive, contracted, $523 billion backlog.
And it's all underpinned by that unique multi-cloud moat that competitors just can't easily replicate.
That summarizes the monumental trade-off perfectly. The critical question isn't whether they can build the data centers. The RPO suggests the demand is absolutely there. The question for you, the investor, is whether you are willing to accept 3 years of red ink on the free cash flow statement today.
For the chance at that 28% growth 5 years from now.
It's a huge bet on tomorrow, funded by today's profitable software business. And management has to prove that operating leverage will materialize quickly enough to pivot FCF back to positive and justify the debt before the next competitive wave hits.
That is definitely something to track and a fantastic framework for viewing this company moving forward. If you found this discussion valuable, don't forget to subscribe to the podcast for all our future investment analyses.